Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 9, Exercises Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And so for this video, we are working on exercise 9-31. Get my pen. So it says here, Venus Corp issued a $460,000 8% mortgage on January 1st to purchase warehouses. Requirement: complete the amortization schedule for Venus Corp, assuming payments are made semi-annually, round amounts in the nearest dollar, and then record the entries for A, issuance of the mortgage on January 1st, and B, the first semi-annual payment on June 30th. Okay, so here's the table that was supplied to you in the homework problem. And as far as the payment is concerned, the payment's going to stay the same, $26,602 all the way down. That's the payment, every single payment. Now, with each payment, you're going to pay principal plus interest is equal to your payment. All right, so we know the payment, but we have to figure out the principal plus interest. Now we have a loan balance of $460,000. Right. I'm going to do the math here, but I'm not going to go over. I'm going to do the math for maybe the first or second payment, but I'm not going to go through all of them. All right, I'll leave that up to you to go through all of them and look at the solution in the solution manual. But to understand, how we arrive at the interest in principal, I'll go through the first couple of payments. So we have $460,000 balance. Okay. The interest. Let me do it down here. The interest is going to be the loan balance at that moment in time. Okay, remember, we're going to be reducing this loan balance by the principal amount with each and every payment. So we're always going to be looking at whatever the loan balance was up to that point in time times the interest percentage times, in this case here, we're looking at 6-month periods, right? From January to June, June to December, January to June, June to December. So these are 6-month payments, okay, every 6 months. So times 6/12. So we have to calculate the interest first, right? So we'll take the payment amount, and then we'll subtract the interest, and then that will give us our principal amount. And that's how we're going to find our interest and principal. We know the loan balance. So we calculate the interest, and then we subtract the interest from the loan balance in order to get the principal. Okay, that's amortization. You should already know how to do this. If not, go back, especially in your math for business and finance. This here is not anything new. All right. So in this case here, we have 480,000, which is our, 460,000. Times 8%, okay, times 6/12. And if we do the math, so 460,000 times 0.08 times 6 equals, that gives me 220,800 over 12, and I divide by 12, which gives me $18,400 of interest. So that's going to be our interest here, $18,400. And if our payment is $26,602 and we subtract the $18,400, that gives us a principal amount of $8,202. So $8,202 in principal. Okay, and then from the $460,000, we subtract the principal of $8,202, and that gives us a new loan balance of $451,798. So $451,798. Okay, so go ahead and pause the video because I'm going to erase all of this, and now I'm going to do the next payment. And the only reason why I'm doing it is because, I mean, it's doing the exact same thing as we just did, but the only reason why I'm going to do it is because now instead of using the loan balance of $460,000, we're using $451,798. Okay, because that's the new loan balance. I mean, we're only paying interest on what we owe. So times 8% times the 6-month period over 12. So if I take 451,798 times 0.08 times 6, I end up with 216,863.04, and that's over 12. So I divide by 12, and I get 18,071.92, and we're rounding, so it's 18,702. Right. So if we take our payment of 26,602 and we subtract 18,702, we end up with the amount that goes to principal is 8530. So our principal is 8530, and then of course we have to subtract the 8530 from the previous loan balance of 451.78, and that gives us a new loan balance of 443,268. So it's 443,268. Okay, so that was, I just did June and I just did December. Okay, I'm not going to do all the rest. I'm going to leave that up to you to do all the rest. Okay, because it's all just basically the same exact thing. All right. So number 2 says, record the journal entries for issuance of mortgage on January 1st. So our issuance of $460,000, right? So we're issuing a mortgage, and a mortgage is a liability. I mean, it's money we owe. So we're going to credit mortgage payable, right? Because we increase our liabilities on the credit side for $460,000, and debits have to equal credits. And so what are we doing? We're buying a warehouse, so we're buying an asset. So most likely I would name the general ledger account warehouse and call it in the amount of $460,000. So that is the purchase of the warehouse by issuing a mortgage payable for $460,000. All right. Now I'm going to pause the video, write that down, because I'm going to erase it. Okay, and now we have to do the first semi-annual payment from June 30th, 2014. Okay, so when we're making a payment, we're affecting cash. So our cash is decreasing, so I'm going to credit cash for $26,602. Now, out of that cash, we're paying interest and we're paying principal, right? So the principal amount, debits have to equal credits. So I'm going to debit my mortgage payable, right, for the amount of $8,202. because that's how much I'm reducing it by, and I'm going to debit my interest expense, right? Because I'm paying interest. So interest expense in the amount of $18,400. Debits have to equal credit. So that's my payment, and those are my entries to the payable account and interest. Now, just realize that going forward, this is going to be the entry that you're going to make every 6 months, but every 6 months you're going to have to calculate, your new principal and interest amount for that payment. And when you book it, that's the way your journal entry is going to book. So in the issuance, we issued the mortgage payable for $460,000, and as we reduce our loan balance, okay, as we reduce our loan balance by making the payments, all right, we're always going to be, our mortgage payable account will always be reduced. Okay, this is $460,000. Is always going to be reduced by that principal, so that amount will always be our new loan balance. So I can just readily look at my mortgage payable and know exactly how much I owe on that, on that purchase for the warehouse. Okay, from that mortgage payable. Right. So that's it. Really basic, simple. We've done amortizations before in Math for Business and Finance and earlier in this subject. So if you still don't understand that theory, go back to those subjects. And if you watch the videos, work the problems, and if you still don't understand, feel free to contact an instructor. All right, I'll see you in the next video for the next problem.